Investing is very democratic. It's for everybody. It's the secret that's hiding in plain view. You must get rid of this notion that the stock markets are complex and beyond the ordinary person and beyond you. They are not. If you're already investing in a pension, you're already investing in the stock markets. Financial freedom is a worthy goal, and this online series of investment training seminars will show you the steps that you need to take to get there. Hi, my name is Rory Gillen and I'm the founder of Gillen Markets and the course director for this online investment series titled 3 Steps to Investment Success.
And my name is Aileen O'Reilly. I actually know nothing about investing, but I'm keen to learn. So I'm joining the class for this online series. Then I'm going to act as a moderator for a Q&A at the end of each module where I'll put the questions of the whole class to Rory. So Rory, who are you? Why are you the man for this job?
Well, first off, I've been in the investment game or the stock markets for most of my working life. I've been on the institutional side, I've been on the fund management side and on the private client side. So I know it from a lot of angles, and I've always seen the markets through the retail investor or the private client's point of view. So I tend to like to think like the private investor, and therefore I think I've got used to answering the key questions from the private investor's point of view.
And so that's what led you into the investment training.
Yes, I have a great appetite to provide an understanding to people as to what the stock market is and why it can be used and why it's a great democratizer, that it's for everybody. And I think some people have an appetite for teaching. I'm a practitioner at heart because we run a business. But also I like the training side of things, and it's just, I think that's either in you or it's not. And I've been doing the one-day stock market or investment training courses for since 2005, and they've been mainly offline, as in hotels, for anyone that came along. And therefore I think we've got a pretty good tool set in terms of understanding what the private investor can absorb and what the key messages are and how to get them out of the blocks. Essentially, the stock markets are a great democratizer. It's not the case that they're the preserve of the wealthy. That's most untrue. And in the stock market, you can actually build wealth brick by brick, as in, slowly. And it's an essential part of life, in my view. There's lots of other essential parts of life, but I think it gives you great options in further down the line in terms of if you build a second income using a savings and investment program, that you then have the choice to either give up your existing job if you don't like it, or to take a year off, or to you just get more flexibility, and also you make your retirement a lot easier.
Financial freedom.
Yeah, yes, and financial freedom is within the grasp of most people in society. It does not depend on your income. What you do have to understand is that you've got to save some of your income to get off the blocks. And it takes time and it takes a bit of patience, and there's rules to follow, but they're not that complex. And it's really got to get the stock market demystified. And I think this online series will seriously demystify it for you to the extent that you will grow in confidence by doing them each module after the next. And you will end the course with enough knowledge to get going. Right. And how to then control risk. Yeah, no, that sounds great, because I definitely would be in that category of people who thought, it's not for me, I couldn't possibly do that. It's all the kind of, the scenes in movies with trading and shouting and crashes, and, I would have just thought, I didn't realise that it was something that an ordinary person could learn to do. Yes, well, remember that's how it's portrayed in the media. That isn't necessarily what's at the heart of why the stock market works. And what's at the heart of it is that it just reflects businesses. And you can take a Ryanair, and Ryanair just started as a low-cost airline and has gone from 1% market share of the European sort of short-haul market, which is short stops, to owning 15% of the market because of its low cost base. A very good company, and anyone who owned shares in Ryanair for that journey did very, very well. So investors and new investors need to know that really stock market is just reflecting business. Business generates wealth, and you can have part of that if you save through the stock market and learn how to do it, because it is different than investing in physical property. Each has its own pros and cons, and you need to learn the pros and cons and the rules that work in the stock market. It's slightly easier to understand what works in property, even though we've all learned some lessons about property investing and how difficult it is if you get it wrong. And you need to learn some lessons about how to do it correctly in the stock market. And the series will I'm very confident will do that for you.
So who is the course then aimed at?
Well, it's aimed at a range of groups. It's the person who can actually save 100, 200, 300 euros a month, can easily get going in the stock market. One of the benefits of the stock market is that you can invest very cheaply. It doesn't cost much. It's aimed at somebody with a lump sum to invest. That can be somebody who's sold a piece of land, sold a business, has been left some money, or has actually saved money and it's in bank deposits and they want to actually get a better return. It's aimed at existing investors who want to improve and who have maybe been making errors at the wrong time for emotional reasons perhaps, and need to get more of a plan in place and understand that. And it's aimed at people who are in the industry in some way, like pensioner trustees, if you're a trustee of a pension scheme, a company pension scheme, you just want to know a little bit more about this area, then I think we've got a pretty good package for everybody.
So it'll work on one level for somebody like me who's a complete novice, but there's plenty in it for those with more experience.
Absolutely, yeah. I mean, one of the great problems with the stock market is that because it's volatile, it tends to play on people's emotions. Whether you're an experienced investor, whether you're a novice, the emotional ride is a little bit tougher than is the case with physical property, and you need to learn that. And your plan, those 3 steps, need to deal with that, and that is across the divide, I think.
So, are you going to make me rich quick?
Absolutely not. And the key to this is that it's not about getting rich quickly. It's quite the opposite. And that's either a source of comfort to some and it's a turn off for others. And people will find out whether they have an appetite to do this series, this online series, or not. And we're not trying to pretend that it's got the quick answers for anybody. The reality is, if you're trying to save and invest, it's a slow journey. And if you're starting off the blocks afresh with no money and you're trying to save on a monthly basis, then it surely is. It's at least a 6 to 7 year journey. But it's very rewarding and it's very low risk if you're not introducing debt. We don't support the use of debt in any form in the case of saving and investing through the stock markets.
But you believe it is something that I can learn and everyone can learn to do?
No, absolutely. I mean, let's take the car analogy. I mean, everyone wants to drive the car when they're at a certain age, but they take it for granted that they've got to learn how to drive. So they take lessons. And then when they have the lessons done and they've passed the test and they're ready to go, they go out on the road and they pay attention to the lights and they pay attention to the lanes they're in, pay attention to cars around them. They pay attention to controlling the risks of having an accident. And even if they have done everything right, they know somebody can land into the side of them. So there's no guarantee, but you know what you have to do to get driving right. You learn and then you practice. And you get the benefits of driving, but there's no guarantee with it. It's the same in the stock market. You have to learn. And, I'm amazed that there aren't more proper courses around. There are courses around that teach you how to trade stock markets. I do not support them. I think they will send you down the wrong direction and give you false messages. But a course that teaches you how to invest, wisely, needs to give you the rules and show you the pitfalls, and needs to give you a plan that deals with risk, because there is risk in the future, there's risk in the business world, there's risk everywhere, and you just need to have a plan that mitigates or offsets those risks. And then you should be able to get the benefits of stock market investing, which is higher returns than bank deposits over time. That statement doesn't apply on short-term views, but it does apply over time.
Well, that all sounds great, Rory. I'm looking forward to getting started.
Great. Hi, welcome. And this is a short introduction to our online investment training series that we believe passionately about, and that is a very good thing to learn in life in terms of a sound saving and investment program. It can help you through your life, it can change your life. What the course is about, it's about achieving financial freedom with the minimum of risk. And that's important, the minimum of risk. It's about gaining an understanding of what constitutes sound investing and a sound investment plan. It's about understanding why the stock markets deliver better returns than, say, bank deposits. It's very important to understand that because if you do understand it, you're much more likely to believe in it and therefore to get through difficult times, and there will be difficult times. We like to believe that it's about understanding the 3 steps that are required to make a success out of investing. And that was how we titled the course when we started the course in 2005, and that title hasn't changed, and I think it is still the most appropriate title because you've got to understand the power of compounding, which means patience. You have to understand that there is easy approaches to follow, that it isn't that complex, but you've got to know a little bit more about it before you can accept that actually there is an easy way to do this. And you've got to understand that the stock markets are volatile, and you've got to cope with that. And any plan you have, easy to follow plan, has to deal with the volatility, because the volatility will never go away. It is the nature of the beast. But you can understand it and cope with it and not let volatility debunk your plan. And that's the key. So the bottom line is investing needs training. You're not born with a good idea of investing. Okay? You don't learn anything about it in school. You learn very little about it in university if you've gone to university. So it needs training. So where do you get it? We would like to encourage you to do our online training course. We have developed this over many years. So I think we understand what people understand and how to pitch it correctly and bring across the concepts that you may think are complex and to make them easy for you to follow them and have the confidence to take it on from there. Just let me say, make an analogy between driving and investing, because I think this is very, very important. Driving can be dangerous. It's risky. Okay? You can, there's risks of accidents, and if the basic rules of driving are not adhered to. So to control those risks, automatically we know that we've got to take some driving lessons. And then when we're driving a car, we pay attention to the road signs. We don't drive like racing drivers around congested areas. We pay attention to traffic lights, all those issues that you use when you're driving to limit the risk of having an accident. It's the very same with investing. If you learn the rules about sound investing, and then you learn how to mitigate the risks or to control the risks, you get the benefit of investing in assets that can deliver better returns. You don't get a guarantee with that, but you don't get a guarantee with driving a car either. Just because you're driving safely doesn't mean you'll have an accident. And you accept those risks with driving, and so too you should with investing. My own journey on this wasn't straightforward. I've made plenty of mistakes, but I'm at a stage where I make less mistakes these days. I still do make them because it's a part of the process. But certainly when I was starting in the industry and was a lot younger than I am today, I bought shares in a company called European Leisure in 1991. It was a night and leisure club operator. In hindsight, it was a poor business and had too much debt, so therefore lots of risk in it. I thought I knew more than others. I couldn't accept that I was wrong, and therefore I persisted a lot longer than I should have. Persisting means, well, when the price came down, I bought a few more, and a few more, and a few more, until the pain threshold got too much. And it was probably the greatest error I've made in terms of not understanding that I had to accept that I was wrong at some stage. And I ended up doing a lot of damage, taking a permanent loss. And the simple lessons were, well, I wasn't diversified, and I got stubborn. And stubborn is an emotion. It's an attitude. It's not logic. And in the stock market, you can be as logical as you want about things, but emotion takes over. The old greed, fear, and whatever. And they do take over. And any plan you have, that easy to follow plan that I'm promising you, has to be able to deal with the emotional side of decision making so that you don't rely on your emotions when making decisions. So in investing, just to give you a little bit of background, there's two types of investors in our view, the regular investor and the lump sum investor, and they have different risk profiles. And it's good to understand that, and we certainly go into it a lot throughout the course. The regular investor is essentially somebody who's investing as they go along. So that the amount that they're investing in the beginning is not particularly important relative to what they'll invest over time. The lump sum investor is completely different. They have actually a lump sum that they don't want to lose, obviously, but they won't have much to invest alongside that lump sum relative to the lump sum itself. So it puts them in a different position in terms of risk. The regular investor might be somebody, this is just a chart that shows you the example of somebody who started in late 1999, saving €500 a month into the stock market, and that can be done through a product that replicates the stock market for you, a global equity fund, for example. And the straight line there just shows you the actual monies that you've invested cumulatively over time. So it starts at 0 up to 500 and all the way along by 2021 of just over 120,000 saved through that program. The volatile line shows you the value of that investment as you go along. And you know that there was, from 1999 to 2002, there was a global equity bear market. A bear market is a market that is going downwards. Economic, whatever's going on in the economies, with interest rates, politics or whatever, Gulf War, that were affecting the stock markets. You can see that the value of your money was basically below what you'd been investing for quite a period of time there. It got ahead then. It started doing what it should be doing, which is to move forward beyond what you'd invested. And then you got hit with the global credit crisis through 2008. So you had another downdraft. But again, no need to panic. No permanent losses were taken because you didn't take any, because you were following your plan. And the rest has been pretty much upwards since, because we've recovered from the global credit crisis and we've had low interest rates and other things that have made the markets attractive to investors versus, say, bank deposits. The lump sum investor is different, and the lump sum investor has to cope with recessions and bear markets because they don't really get to add new monies when markets are lower. Whereas the regular investor does, the lump sum investor doesn't. And therefore it's important to understand how to mitigate the risk for the lump sum investor. The green line is if you're in global equities, and you'll take the ups and downs of global equities if you decide to invest your lump sum at a certain point of time. This is in late 1994 or early 1995. The green line assumes you were in global equities. You had a couple of nice years up to the late 1990s. You had the tech bubble, and when that crashed, it brought global equity markets down over the next couple of years. You had recovery, and then you had the global credit crisis, and you've had the recovery since. So it's been pretty much, you'd call it a roller coaster ride, but you're well ahead of where your lump sum is, but it was a roller coaster of a journey. Again, you have to understand why that is, and if you decide to go that way with a lump sum, you've got to be patient, and you've got to avoid overvalued markets. That comes, and that explanation of how you do that comes during the series that we offer, or the online series. The red line is owning assets that mitigate the risks. So, for example, if you ended up in the global credit crisis and you had part of your portfolio in bank deposits, well, of course, the capital value of your savings doesn't change. So if equities are declining during that period, the bank deposits are mitigating that loss. If you owned fixed income government bonds at that stage, which started off with a fixed income, every investor wanted the fixed income government bonds because they come with a guarantee, so their prices actually rose during the global credit crisis, offsetting the losses in equities. You may also have owned inflation-linked government bonds, which basically are there to mitigate the risk of inflation, and they too would have done well during the global credit crisis. And then if you owned gold, which is basically the fifth asset class, for reasons I won't explain just now, but does get explained during the series, gold would have actually been like equities during the global credit crisis. It lost money for you. But out of those 5 assets, there was 3 that were offsetting, giving you positive returns, while some were giving you negative, but you got through the global credit crisis with your capital relatively intact, and that's why that line is smooth. But each of those asset classes is doing something different. Each of them is offsetting a risk, while at the same time you're benefiting from growth, and that's where the smooth line comes from. And now an outline of the course that is available online. There's 9 different modules. You'll see there that I've labelled some of the modules Step 1, Step 2 and Step 3. And of course, that's what you need to actually implement your plan. You need to compound, that means save. Step 2 is just finding an easy to follow approach for yourself. And Step 3 is understanding volatility and coping with it. They are the 3 steps to investment success, as we call it. The other modules are clearly the building blocks behind why they are the 3 steps. So in the first module, we've got sort of financial planning and we've got compounding. We've got why do the stock markets produce better returns, because you need an understanding of that. If you have an understanding of that, you're more likely to be confident and to trust that that is correct. And you will need that trust at times when markets are poor. You need to know the long-term returns that stock markets have delivered versus other assets, because then you've got choices. And you need to understand those choices. There are different ways that you can get exposure to the stock markets, and you need to understand that as well. That's Module 3. Module 4 deals with the big bogey. It's speculating versus investing. The stock markets fulfill the gambling instinct in human nature. You need to avoid that like the plague, and you need to understand what is sound investing. We teach that in Module 4. And it's most definitely not about getting rich quickly. Yes, you may have heard of stories of people sort of multiplying their money on some individual company, and you'd love to do that, and perhaps you even think that's what stock market investing is all about. Well, the reality is it's not, and that's a fluke, and great, we'd all love a couple of flukes, but you can't rely on it. What you need is a sound plan that works over time for you, and time is your friend. And if you stay the course on that, you will achieve financial freedom. Terminology can be something that just puts people off, so we demystify that. But you don't need to be an expert in stock market terminology. The only terminology you need in property, for example, is rent and the rental yield, which is the rent you get versus the price you paid for that property. There is a little bit of extra terminology in the stock market. We deal with that in Module 5, really to just demystify it for you. But again, you don't really need to know too much about it. And then the impact of interest rates, because it's important to understand that interest rates moving up or down does impact stock markets and indeed property values, and it makes sense to understand why that is. There's always a preponderance to saying, well, I can always invest in property, why do I need the stock markets? And we deal with that whole issue in Module 6, which is physical property investing versus stock market investing, the pluses and the minuses of both. Each has its own merits and each has its issues. And it's good to understand because, again, it comes down to choice and understanding. Module 7 is all about the easy-to-follow approach that you need to actually adopt. And when I say you, what I mean is each individual is different. Some person will always want to own individual companies, may want to be a little bit more active than perhaps they should be, but they like the interaction or they like the buzz of that. Others are quite happy with a very passive program and they're comfortable doing it themselves, and they want the easiest route to doing it and the one that impacts on their time the least, and that's fine. So an easy to follow approach is different for everybody, so you have to find your own. And so Module 7 deals with that for you. Probably the biggest bogey of all is that the stock markets are volatile. They'll always be volatile. It's the nature of the beast. You've got to understand why are they that volatile, and having that understanding, and then to say, well, what am I going to do about that? And how does my plan actually deal with that so that I don't end up making emotional decisions at the wrong time and taking a permanent loss in, say, March 2009, just because I was depressed about markets, when there was nothing wrong with what I owned. And so you have to understand that difference between volatility and risk. And so Step 3 is a key step. What can you do after this course? You certainly have the confidence to start your own personal savings program and even manage your own pension should you choose to, but it's not necessary. You can have your own savings program going with personal savings while having your pension with your company or with an advisor or whatever. None of this is exclusive. You can subscribe to our investment newsletter, because we've been writing an investment newsletter, which is weekly, and it's online, and it's available through our website since 2009. And it's built for do-it-yourself investors who don't want to do the work in terms of what they should own themselves, and they prefer to outsource that to a newsletter because it's great value in terms of what you're actually doing, but you have to be able to do it yourself and want to do it yourself. So you will have that choice. You can become a client of our company. We're investment advisors, and we do have a minimum of assets that we take on because we're a boutique investment advisor, but at least for many, you will have that choice. And, if you already have an investment advisor, I think our series on investing and finding a sound investment plan and understanding things a bit better will, put you in a position where you're understanding what your investment advisor is telling you, so that you'll have more trust and a better relationship and just a better experience. So thank you for that, and I hope you're thinking of doing this course. I think it's a life changer. I wish somebody had come up with this course for me when I was in my early years of trying to learn, because it cuts out a lot of the errors that everyone's prone to making, and fast tracks your journey to where you should be, which is gaining the confidence to understand what a sound saving and investment plan is, so that you can debunk what you hear in the media mostly, and be self-confident. And from that should make a big change in your life if this is something you're interested in. And it's most definitely not about getting rich quickly. Yes, you may have heard of stories of people sort of multiplying their money on some individual company, and you'd love to do that, and perhaps you even think that's what stock market investing is all about. Well, the reality is it's not, and that's a fluke. And great, we'd all love a couple of flukes, but you can't rely on it. What you need is a sound plan that works over time for you, and time is your friend. And if you stay the course in that, you will achieve financial freedom. What do I mean by financial freedom? It's a relative concept. Ultimately, if you're working and you're saving, it's your savings program can actually eventually cover your annual outgoings. If it can, you have the choice to give up work. It may just position you to take a world tour, a year off work and go on a world tour. It may mean that you can actually give up work. So different, for different people it means different things, but I'm keen to say it's a relative concept. But it is one that if you can cover your outgoings from an investment plan, then you will achieve financial freedom. For one person, that means a certain amount of money. For another, it means another amount of money. It's different for everybody, and it comes down to how much your annual outgoings are, actually. Okay, that's the end of the introductory session, and we'll now move on to a question and answer session, which will deal with some queries that normally crop up.
I really enjoyed that, Rory. It has definitely whet my appetite for the rest of the course. A few practicalities. How many modules are there? What duration? How do you recommend that somebody would do the course?
Yeah, there's 9 modules, and they're 30 minutes each. A couple of modules are a little bit longer than that, maybe up to 40 minutes. There's some who are a little bit shorter. We would recommend that you do it, within a short enough space of time. Probably try and complete it within a couple of weeks. The reason for that is because you need to keep the momentum up and keep your enthusiasm up. And also, I think you can easily handle 2 modules a week, for example, one at the weekend and one during the week. I think just have a little bit of discipline about it.
Okay, so how do people sign up, Rory?
Well, all the details are on the website, gillenmarkets.com, and the price point is there. It's at a very affordable price, which is the aim. The contact details for the office are there. How to sign up for the course is there, and details of the complementary offerings, which include the main book we wrote back in 2012 and the couple of booklets we published since. They all come as complementary offerings, and then of course there's the discount on membership to the website should you choose to become a member to the website, which is the newsletter. There's a 50% discount to that as well, as outlined there.
Okay, it all sounds good. I'm looking forward to getting started.
Great, thank you.